Good day, everyone. Today we are going to understand the second stage in the accounting cycle, which is the recording of the internal transactions. We are done with the recording of the external transactions, which are based on the source documents. The evidence supporting the journal entries for external transactions are available to the bookkeeper or accountant. The only analysis done is to determine the impact of the transactions contained in the source document. In recording the internal transactions, however, the accountant or bookkeeper has no source document to base his entries on, considering that internal transactions are non-exchange and only the business is being affected. There is no need for a source document in the internal transaction because the business does not need to validate itself. Source document is necessary in case there is conflict or issues to be resolved between the contracting parties. Since there is no source document to support the recording of internal transactions, it is a logical method to review the unadjusted trial balance and determine which accounts have to be updated and adjusted. So we're done with the first stage recording of external transactions. We are now with the recording of internal transactions, and this has the following steps. Analyze the unadjusted trial balance. Once analyzing the trial balance has been completed, the necessary adjustments should be made on the accounts that need updating. To make the journalizing simpler and more organized, special tools in the computation of adjustments may be used. And these are the worksheet and the accounts. To avoid errors in recording in the actual books, journals, and ledgers, adjustments are made in an accountant's draft called worksheet. The worksheet provides a scratch pad for the accountant or bookkeeper so that all adjustments are identified and listed first in a draft before actual entry to the books are made. So this is a list that provides some of the most common findings after analyzing unadjusted trial balance and after gathering data needed for adjustments have been performed. The business usually has a standard set of potential adjusting entries for which it should evaluate the need at the end of every accounting period. These entries should be listed in the standard closing checklist. The standard adjusting entries used should be re-evaluated from time to time in case adjustments are needed to reflect necessary changes in the presentation of business information. So let's take a look at these adjusting entries which are commonly which were found after analyzing an adjusted trial balance. So we have the cash shortage after a cash count, cash shortage after a cash count, then remaining merchandise inventory at the end of the period after physical count, noted reconciling items in the bank reconciliation. So these are items for adjustment. Interest income on notes receivable and interest expense on notes payable. Doubtful accounts expense or bad debts. remaining supplies and used supplies, remaining and expired portion of the prepayments such as rent, advertising, insurance, and other prepayments. Depreciation of fixed asset and amortization of intangible assets. Impairment of an asset. Revenue earned on advance collection previously recorded as unearned revenue. Remaining liability or unearned revenue on advance collection previously recorded as revenue. Accrued revenue. Accrued expenses. Errors in journalizing and posting external transactions. So, as shown in this list, adjusting entries commonly consist of 4 types, which are accruals, income na but not yet received. Income, accrued revenue is an income already earned but not yet received. Accrued expenses are expenses already incurred but not yet paid. Now, the other one is deferrals. So, these are revenue advance. This is either advance collection or advance payment. So, advance collection of previously recorded as unearned revenue. Advance collection of sales or revenue is an unearned revenue because there is still an obligation to perform. This has not yet been performed. So, deferrals, money received in advance for a performance, for a service to, or sales to be performed later. So, that is a deferred revenue. A deferred expense, on the other hand, is an expense paid in advance but not yet incurred. So, these things have to be adjusted, deferrals and accruals. Another form of adjustment or another type of adjustment is the setting up of estimates, calculating the possible amount of loss, expense, or reserve, such as the allowance for doubtful accounts or allowance for depreciation. The third one is the correction of errors in journalizing external transactions or neglect to record transactions. Before we make actual entries of these adjustments on the journal and ledger books, we have to make calculations of the actual amount and the identification of appropriate accounts to be debited or credited. Unlike in recording external transaction, which requires a little analysis, recording of internal transaction needs deep analysis in order to record the correct impact of the adjustment on the financial position of the business. And because analysis in recording the internal transactions or adjusting entries is difficult, it is wise to use a draft to calculate each adjustment before actually recording them in the official books of the business. Accountants and bookkeepers use the worksheet as a draft to compute for all the necessary adjustments and to likewise provide basis for the adjusting journal entries. What is then a worksheet and how it is being used? Worksheet is a sheet that is used in making preliminary plans, auxiliary computations, notes, or comments as a guide in doing some piece of work. In accounting, it is a working paper used by an accountant to assemble figures for financial statements of a business. A worksheet is a multiple column form that is used in adjusting ledger balances and preparing financial statements. Columns of the worksheet are drawn mainly as per necessity. The number of columns of worksheet depends on the demand of the particular business or organization. The worksheet is not a permanent record or document. It is not a part of the journal or ledger. It is a device or tool used for easy preparation of adjusting entries and financial statements. The worksheet is a multi-column sheet or a computer spreadsheet where the accountant writes, in brief, information necessary for the preparation of adjusting entries and financial statements. This is the basic format of a worksheet. The number of columns of worksheet and titles of columns depend on the nature and needs of the business. We have the number one part as the name of business, organization, and preparation date, and the word worksheet. At the beginning of the worksheet, the name of the organization for which the worksheet is prepared is to be written in bold fonts, and below the name, the date of preparation of the worksheet. This second one is the particulars. We're done with this. Now we're on the particulars or item column. This is the column for the account titles used in the preparation of the trial balances. So next will be the unadjusted trial balance column. So particular column, unadjusted trial balance column. This is the column for the amount of each account in the unadjusted trial balance. The unadjusted trial balance is the summary list of all ledger accounts balances after all external transactions have been recorded. This trial balance is also called pre-adjustment trial balance since the balances in the accounts are not yet adjusted. All the balances in the ledger accounts are listed in the unadjusted trial balance. This is the adjustment column. So, this adjustment column is the column used to journalize internal transactions, updating entries and correcting entries. All accounts which have to be adjusted, updated, and corrected are analyzed and appropriate entries prepared to reflect the true financial position or condition of the business. All account titles necessary for adjusting, updating, and correcting entries which are not listed in the unadjusted trial balance shall be listed under the last account title of the unadjusted trial balance. The debits and credits of the adjustments are identified using letters or numbers of the adjustment as cross-reference. After plotting in the adjustment columns all the debits and credits of all adjusting entries, the debit and credit column shall be totaled and must be balanced. The adjusted trial balance column. So, the adjusted trial balance column. The adjustments will either increase or decrease the debit or credit of the affected account, and the balances should be adjusted correspondingly. The remaining balance or adjusted balance shall be listed in the appropriate column of the adjusted trial balance section. The adjusted trial balance is also called a pre-post-closing trial balance. The adjusted trial balance presents complete external and internal transactions for the period, but the accounts are still open and yet to be closed to the capital account. That is why it is called a pre-post closing trial balance. So after the adjusted trial balance, we have the closing entries, and then the post-closing trial balance, and then the income statement. So the closing entries and the post-closing trial balance are not usually presented in the works of some books, but I would like to present here this these items here in the presentation of worksheet, so that you will see that from the unadjusted trial balance there will be adjusting entries. To complete all the transaction, you arrive at the adjusted trial balance. All the transactions are recorded, but not but these balances now should be forwarded to the income statement or balance sheet. But before you can do that, you have to close all the items pertaining to the income statement. So whatever will be left will go to the balance sheet. So I included these items in presentation, although not much of the books I've read have presented this, but this is necessary for the understanding of the presentation of the income statement and the balance sheet, because the closing entries will zero the income statement and the remaining accounts will go to the balance sheet. So the income statement column, all the account balances in the adjusted trial balance will be analyzed and grouped in the particular statements they belong. Income and expense accounts are forwarded to the income statement sections, and the asset, liability, and capital accounts are forwarded to the balance sheet section. The difference between the total debit and total credit in the income statement section will be either net income or net loss, which is forwarded to the balance sheet section to be close to the capital account. If the debit is greater than credit, it is a net loss. If the credit is greater than debit, it is a net income. So the next one will be the balance sheet. All assets, liabilities, and capital accounts in the adjusted trial balance are forwarded to the balance sheet column or the balance sheet section. And the resulting net income or loss is either added or subtracted from the capital account. The drawing account is deducted from the capital balance to close the drawing account to the capital account. Let me emphasize that this worksheet is not an official document or business record. The data used in the computation of net income and accounts final balances should be recorded in the appropriate books of accounts. Journalizing the external transactions or preparing the adjusting entries. So the adjustments in the worksheet shall be recorded in appropriate journals and then posted to the related ledgers to make the information parts of the official records of the business. When the BIR, Bureau of Internal Revenue, reviews the financial statements of a business, the BIR examiner will demand only the books of accounts and financial statements officially submitted to the BIR. Therefore, all the entries made in the worksheet should be recorded for the journal and ledger to make this information official. The worksheet itself does not bear any value when it comes to being an official document. Let us take a good look again on the trial balance of Terimacor and the necessary adjustments that have to be made to update the account. So, let us assume that this is the unadjusted trial balance of the Rimacor at the end of the period. In here we have listed all the external transactions. We are going to write this unadjusted trial balance as the first section of the Terimacor's worksheet. So this is the first section of the Terimacor worksheet. These are the accounts used in recording the external transactions, and these are the amounts involved in each transaction in the summarized form in the unadjusted trial balance. There were 13 accounts in the unadjusted trial balance, and after review of each account, 12 accounts were found to be needing some adjustments, which are as follows. It was found out after a cash count that 100 is missing in the petty cash box. The allowance for bad debts is 2% of accounts receivable. After inventory count, supplies on hand is 5,600. Prepaid insurance is for 2 years and was paid February 1, 2020. Trucks are being depreciated using straight line method. The cost of the truck is 200,000 with a salvage value of 50,000 and 15 years useful life. It was found out that there was unrecorded debit memo for Mackerel's medical supplies for defective delivery amounting to 600. Terimacor paid transportation expense amounting to 1,000 out of owner's personal money, and the owner does not intend to be reimbursed for the payment made. There was unrecorded withdrawal amounting to 5,000. Merchandise inventory after physical count at the end of February is 70,000. Weekly wage of the janitor for 3 days were not yet paid because the last day of the period did not cover the entire week. Daily wage is 385. Rent expense is for 2 months, paid in February 1, 2020. Water bill was twice paid, and the payment was not returned but will be credited to next month's bill. Water bill is the only utilities paid by Terimacor Drugstore. From these results of our analysis, we are going to create adjusting or updating entries to complete the records of the business. The external transactions recorded in the first part of the cycle is just half of the information about the business. And to complete the information, we have to record the internal transactions through adjusting or updating entries. The next thing to do is to prepare the worksheet for Terimacor Drugstore, to draft all the necessary adjusting entries, and to determine the correct income for the period and draft the closing entries and financial statements. The first thing to do is to write the heading of the worksheet, as I've said in this portion, and then list down all the accounts from the ledger, the balances from the ledger accounts. After writing down all the necessary ledger balances, go over the list of accounts that need adjustments, that are to be adjusted. So this is the list of the accounts to be adjusted. After writing the unadjusted trial balance, we have to go over the summary list of data for adjustments and calculate the adjustments, then prepare the adjusting entries. So we will discuss one by one what is written in the summary list of internal transactions of Terima Core. So it was found out that cash count, after a cash count, that 100 is missing from the petty cash box. Therefore, there was a cash shortage, and an entry to record that will be a debit to cash shortage, an expense account, and credit cash. The allowance for bad debts is 2% of the accounts receivable. So the accounts receivable here is 20,000. 2% of 20,000 is 4,000. So we're going to debit bad debts expense and credit allowance for bad debts by 400. So this one, debit to cash shortage, credit to cash. This one, debit to bad debts expense and credit to allowance for bad debts. The next item is inventory count of supplies is 5,600. So there was already recorded supplies 8,500. So the method being used is asset method because the asset account is used during the purchase of supplies. So there was 8,500 here. And the inventory count is 5,600. How much will be the expense? We've already recorded the asset. Now we're going to record the expense. That will be 8,500 minus 5,600, which will be 2,900. So there is an supplies expense of 2,900. Now, number 4 item is prepaid insurance is for 2 years. Take a look at this one. The supplies was recorded using asset method because supplies account was debited. This time, it is the rent expense which has been debited, although a part of that expense is a prepayment for the next month. Therefore, this is using expense method of recording transaction because the expense account has been debited. So, in this case, the expense has already been debited. So, we're going to record the asset, what remains unexpired at the end of the period. So the next item will be the trucks being depreciated using the straight line method. Therefore, the straight line method formula will be 200,000 minus salvage value of 50,000 divided by useful life of 15 years. We have to multiply 15 years by 12 months because the presentation of the financial statement is for on a monthly basis. Therefore, we're just going to compute for the month of February depreciation expense. So that will be computed later. It was found out, number 6 will be, it was found out that there was unrecorded debit memo for Mackerel's medical supplies for the defective delivery amounting to 600. So, since this is a debit memo, it is an accounts payable. So the mackerels will be debiting the Terimakor will be debiting the accounts payable for mackerel. So that will be a debit to accounts payable and a credit to purchase returns and allowances. Mackerel's medical supplies is a supplier of Terimakor. So it is Terimakor purchased on account from mackerels, and since there was a debit memo that was unrecorded, the accounts payable were understated, and the purchase returns and allowances was understated too. So we're going to make an adjustment for this unrecorded transaction. So this is a non-recorded transaction. Number 7, we have Terimakor paid transportation expense of amounting to 1,000. This is also an unrecorded transaction. The owner paid out of his own pocket money an expense of the business. We should remember the business entity concept. So if the owner paid something for the business should pay back the owner. But this time, the owner does not want to be reimbursed. Therefore, that becomes an additional capital by the owner to the business. Number 7, there was unrecorded withdrawal amounting to 5,000. Number 9, merchandise inventory after physical count at the end of February is 70,000. So this is Terimakor is using the periodic system of inventory because it has to count the merchandise at the end of the period to have a record of the merchandise inventory. Weekly wage of the janitor for 3 days were not paid because number 10, because the last day of the period did not cover the entire week. Daily wage is 385. So 385 for 3 days, that will be the expense that remains unpaid as of February 28. Number 11, rent expense is for 2 months, paid in February. Therefore, there is an advance payment of 1 month. Was paid for 2 months. Therefore, there is a 1 month advance. Now, we're going to plot the adjusting entries here in the we're going to plot all the adjustments in the adjusting entries column of the worksheet, and afterwards we're going to plot the effects of the adjustment on the adjusted trial balance. So let's take a look at the balance of the cash before adjustment. We have 10,000, but there were adjusting items, which is the cash on shortage and the unrecorded drawing of the owner of the business. Therefore, 10,000 minus 5,100, we have debit of 4,900 for cash. So all these items will be reviewed, and the adjustments will be compared with the balance in the unadjusted trial balance, and the difference or the sum will be forwarded to the adjusted trial balance. The adjusted trial balance is the listing of all company accounts that will appear on the financial statements after year end. Adjusting journal entries have been made and posted to the ledger. Preparing the adjusted trial balance is the last step before financial statements can be produced. Its purpose is to test the equality between the debits and credits after adjusting entries are entered in the books of the company, and to serve as basis for the preparation of financial statements. The adjusted trial balance is not part of the financial statements. Rather, it is an internal report only. So I've already, the purpose is to verify the debit and credit balances and to assist in the preparation of the financial statements. I want to reiterate that this adjusted trial balance here is not a formal document, but a draft in the worksheet. We are going to enter one by one each item in the adjustments found in the worksheet to the general journal and post them to the ledger. So this will be the adjusting entries. Note that there are no entries or record in the posting reference column, which means that these entries are not yet posted to the ledger. And the page number is higher now because we are on the adjusting entries. Because adjusting entries are at the end part of the journal already. So what are our journal entries based on the worksheet? We have cash shortage, a debit to cash shortage and a credit to cash. A debit, the next one will be a debit to bad debts expense and credit to allowance for bad debts. The supplies on hand at the end of the period was computed to be 4,000. How much was that? We deducted from that amount from the supplies before adjustment the remaining amount during inventory count, and we came up with 2,900 as supplies used. So the supplies used will be set up. This one used the asset method of accounting because supplies was debited when purchase was made. So debit supplies expense, credit supplies to record the expense. Now the insurance expense is for 24 months and 1 month, and the expired portion is 100. So the the method used was asset method because prepaid insurance exists in the unadjusted trial balance account. Therefore, we have to record the expense. So insurance expense of 100 is debited and credited to prepaid insurance. Now, the depreciation was computed using a straight line method, and depreciation expense to be debited by 833 and accumulated depreciation credited by 833. Accounts payable for unrecorded debit memo is debited by 600, and purchase returns and allowances is credited for the returned merchandise. Freight out, which is a selling expense, is debited by 1,000, This was advanced by the owner without being reimbursed, so it becomes additional capital. The Terima core capital will be credited to increase it by 1,000. So we have two pages of journal here, page 101 and page 102. So these are the entries in page 102. Terima core drawing 5,000 for unrecorded drawing and credit cash. Then the inventory was counted to be 70,000. We can now set up the cost of goods sold. We can now compute for the cost of goods sold, and we have to eliminate the purchase returns and allowances because cost of goods sold is computed based on the net purchases. Beginning inventory plus net purchases is equal to available goods for sale minus ending inventory, then that becomes the cost of goods sold. So credit purchases will not be appearing in the financial statements of the business because it will be the cost of goods sold and merchandise inventory that will be reflected. Now, salaries expense for 3 days will be 1,115. So debit salaries expense, which is not yet paid, so that becomes salaries payable. The rent expense was recorded initially as an expense. So in rent, it is the expense method that is being utilized. We have already recorded the expense. Now it's the time to record the asset. So the remaining portion is 600. Debit prepaid rent to set up the asset and credit the expense. Now, prepaid utilities, the utilities were found to have excess but will not be reimbursed. So there is a prepaid utilities of 2,500. So the expense recorded as utilities is over by 250. So we credit the expense by 250. So after journalizing those adjusting the external transaction or adjustments or updating entries, we have to post to the ledger the adjusting journal entries. There was already discussion in the first stage of the cycle. The same steps on recording external transactions are followed in recording internal transactions. So we're going to journalize and then post to the ledger and then balance the ledger accounts. Now, so post to the ledger, balance the ledger accounts, and prepare a summary. This time the summary will become the adjusted trial balance. So these are the ledger accounts to which the journal entries are posted. Take note that this has a journal number now because this will be every time there is a posting to the ledger, this should be cross-referenced from where, from what journal page did that entry come from. So this ending balance of course has no page number because this is a balance forwarded from a ledger, not taken from a journal. Okay, so these are all the postings to the ledger. So after all ledger accounts have been posted and cross-referenced, and the journal will appear like this. There is already a post-closing reference entry. So if the journal is if the journal's posting reference column is filled with data, then it means that this entry or the journal entry has already been posted to the ledger. So we're done with journalizing the adjusting entries and posting to the ledger of the journal entries, and we have presented we have presented ledger accounts which have been balanced, totaled, and balanced. So it's now time to prepare for the adjusted trial balance. The discussion was in the discussion on the preparation of the unadjusted trial balance will be followed in the preparation of the adjusted trial balance. Balances in the ledger. This will be the adjusted trial balance of Terimacor for February 28, 2020. So the accounts now are arranged on to how they are presented in the financial statements. So the adjusted trial balance is not a necessary document for information purposes. It is not being given out to people for them to understand the financial condition of the business. No, that is not the purpose of trial balance. But the trial balance is a necessary document as a basis for the closing entries. Before you can prepare the closing entries, it is wiser to prepare the adjusted trial balance. So you will identify which of these accounts will remain and which account will be brought forward to the next accounting period. So it is from the adjusted trial balance that you will know what are the accounts to be closed and what are the accounts not to be closed. So it is important for that purpose, but not as an information system or not part of the information system. Okay. This ends our discussion for the second stage of the accounting process, which is the journalizing of internal transaction. We're done with the recording of external. We're now studied the recording of internal transactions, and we're able to come up with the adjusted trial balance. The next topic will be the preparation of financial statement, and the next topics will be the preparation of financial statements and closing entries and reversing entries. And then we're done with the whole cycle of the accounting process. I hope you learn from this presentation, and wait for the next presentation because that will be the culminating part of our discussion on the accounting cycle. If you are learning from this presentation, please don't forget to like, share, and hit the subscribe button for the latest updates on this channel. Thank you, and I hope that you will continue to watch more of my videos. God bless, keep safe. Thank you for listening.